Hello everyone, my name is Russell, and today I want to share a bit of research I've put together on the RSI strategy or indicator using the SPY ETF as the trading vehicle, and we're going to utilize put credit spreads in our strategy today. Before I go further though, let me introduce to you a website here, patreon.com/MrOptionTrader. And this is something new that I have a project going on and would like to provide some value to option traders looking for information about strategies, different types of things to implement in the market. So if you would like, go over and visit that and check it out. I'd appreciate it. So let's get moving here. First, the disclaimer. I'm not going to read through all this, but basically boils down to I'm not a financial advisor, I'm not a professional, and this information is for informational purposes only. This strategy was back tested on real historical end of the day stock and option pricing, but it was not traded in a real account, so keep all of those in mind. And of course, past performance of any strategy does not predict any type of future results. So again, you need to seek professional advice from someone qualified when you begin to use real money. All right, let's move on. What we're going to look at is the RSI as an indicator. And the RSI, the relative strength indicator, was developed by Welles Wilder back in the 70s. It is, of course, an oscillator that charts current and historical strengths and weaknesses of price action in a stock or the market itself. And it's based on closing prices of a trading period. And usually the default trading period is 14 in most software packages. But some recent research shows that shorter time periods may be a higher probability setup. And that's what we're going to focus on today, is changing this 14 to a shorter time frame. We're actually going to be using a 4 as the default trading period instead of 14. So here's a look at the market, the SPY, over the past several months. And of course, this is a line chart indicating closing prices. Green lines obviously are up days, where red lines are flat days or down days. The blue line is the 200-day moving average. And down at the bottom of the screen obviously is the RSI oscillator. And here you see where we've changed the 14 to a 4 for the periods that it focuses on. We've also changed the overbought and oversold numbers. Usually overbought in most software packages, the default is 70. We've tweaked it down to 65, not that it really matters in this study. And we've changed the oversold indicator, which is usually defaulted at 30, to 45. And here you see these yellow arrows indicating when the indicator becomes oversold, when it dips below the 45, and then the yellow lines where it gives a trigger signal that, hey, the market is recovering a little bit and maybe a good buying opportunity. So there's an example there. Here's another example. And then finally a couple other examples. You will notice a couple arrows sometimes together within 2 or 3 days. And that's what happens sometimes. You get a cluster of trades all at once, and you may go periods of weeks or even months without a signal, and you have to sit on your hands if you follow this strategy to the T. So also keep that in mind. Here are our rules for trade entry and management. The trigger is when the RSI is again set at 4, crosses above the oversold level at 45, and the SPY itself is above its 200-day moving average. So here you see all of these signals here are valid signals because the SPY is indeed above its 200-day moving average. What we will do is sell to open a SPY put credit spread at the market with about 7 to 11 days until expiration. We're focusing on short-term weekly options. And I'll show you an example here in just a moment. We will hold until expiration. We will not have any stop losses. And we're going to risk 5% of our trading capital. No more than 5% will be allocated per trade. We will sell one tranche of spreads and disregard multiple signals. Now what this means is If we have a $10,000 account, which is what the study hypothetically assumed was a starting balance, and 5% of that would be $500. So we would sell $500 worth of $1 wide put credit spreads, and we would disregard multiple signals. So if we had a couple of signals within 2 or 3 days, this second, third, or fourth signal that would pop up would not be taken, because we're only going to risk 5% of our trading capital in any one particular instance or at one time, and commissions were not included. So here's our example. Back on July 3rd, 2018, there was a signal that fired off. That day the market closed at 270.9. It was a down day, about almost $1. So what we would have done is sold an at the money put, which is one slightly in the money put at 271. The bid and ask are here, and the mid price at 250, and the 270 $1 wide we would have bought the put at 209, 213, or roughly 211 mid price. So if you subtract 211 from 250, that would give you 39 cents. You would have had a credit you would have taken in. So if you subtract that from $1, which is your spread width here, that gives you $61 that you would have at risk for this one particular trade. You couldn't lose more than that. And so what we would do is take that 5% or $500 and divide it by the 61, and that would give us roughly 8 contracts we would trade. So that's our one tranche in this particular case of 8 spreads risking $61, so just a shade under $500, $480 and change is what we would lose if everything went south on us. So remember, we were targeting short-term trades, short-term expirations, weekly options. This one had 10 days to expiration. So on July 3rd, those were the numbers. And 10 days later, here you see expiration. The market had rallied to 279 and change. And so basically these options at 271 and 270 were worthless. So that 39 cents we collected would have increased our account balance, which would have been a nice thing. You'd taken that $39 multiplied by 8 spreads, so you would have had a little over $300 your account would have grown by. So just to give you a time frame, we in this study went back 10 years in the SPY. If you remember, in the tail end of 2008, there was a nasty meltdown. So this is one particular reason I wanted to target on 10 years and see how this strategy would have performed. And interestingly, we didn't have any triggers during this meltdown because the market had fallen below its 200-day moving average. So any signals that were generated during this period of time were ignored. We actually didn't get into the market by the signals until about mid-2009. And of course, we've been in a bull market pretty much since then. One thing I want to compare is, what if we had just bought and held that SPY during all of this time? What would it have looked like? What if we had taken our $10,000, dumped it in the account here, and held it all the way to up here? We'll talk about that in a second as well. So here are the results for that buy and hold strategy. And these are various criteria you can determine if a trading strategy is good or not good, how it performs, how it stacks up, to compare apples to apples. So there's obviously no win rate with a buy and hold. The reward to risk ratio was 1.71. Anything over 1 is good. But here's the big thing, the max drawdown. Almost 50% you would have lost of your $10,000 would have gone almost to $5,000. So not many people could have handled a downturn like that and been very comfortable with it. But it was profitable. It annualized a return of about 8.23 over that 10-year period. It was a 220% profitability. So that was the buy and hold, kind of give you an idea for comparison's sakes. Now the results for what we did back in slide 5, the option strategy of selling put credit spreads, we had a win rate of 72%. There were 123 signals generated during that 10-year time frame, and so we won 7 out of 10 times. we had a reward to risk ratio of just over 2, which is very, very good. And we had an expectancy of $531. Now, what expectancy is, if you're not familiar with it, is a formula where it kind of gives you an idea what to expect, going forward if these numbers were exactly the same and how it would play out. Again, historical numbers are not any type of predictor or gives any future guarantees, but this is what the numbers crunched out to be. You take your win rate and what your average win trade was, and you subtract that from the losing rate, which would be about 28%, times the average loss, and that gives you this number of $531. So every time in the history I traded this strategy, I could expect the result was $531. And another thing was there was just a 3 for max consecutive losses during this time frame. But here's the thing, the max drawdown was 26%. That's a little too much for me. I'm a kind of a risk-averse person, so I'd like to see this number lower. There again, the number of trades was 123. The average number of trades per year was over 13. You may say, well, 123 divided by 10 is not 13.43. That's true, but if you remember what I said earlier, where we didn't even enter the market until mid-June, and so that gives this number a little bit higher than the 12. The profitability was 338%, and the annualized return was just under 17%. So here's how a $10,000 account would have grown up to just over $30,000 as of a few weeks ago. I'm recording this at the end of August of 2018. And here's this drawdown of 26% that you incurred from the start. Remember, we had 3 consecutive drawdowns at 5%, so that's 15%, but there was also some maybe win 1 and lose 2s in there as well, so that's why the 26% shows up right here. So the takeaways from this strategy, shorter term RSI strategy may be a viable strategy to consider when you're trading with options. But the main takeaway is, with any trading strategy, money and risk management is the key to long-term success. So I hope you enjoyed this brief study we did and put together. This was my first attempt. Hopefully you gained some value from it. That was my intention and my goal from this and the Patreon website. So if you'd like to go over and visit for additional information and some other research I'm putting together and putting on that website, feel free to check that out. If you would like, also, I'd encourage you and would thank you if you would like or dislike this video and give your feedback. I'd appreciate your honest feedback so I can hopefully get better. Hopefully these videos will get better with time, and hope to see you soon. Thanks a lot.